If you missed this was one of the major highlights of what happened in the market today. The Federal Reserve Chairman Jerome Powell just spoke, and I'm going to read into some of the notes he mentioned that have a direct impact with what could potentially happen here with the AMC stock. So let's get into it. This was something that a lot of people in the market, in the economy, was expecting, especially after we had some numbers coming from how the job market is looking at. Because remember, I've always said this, the Federal Reserve has two main targets, two main responsibilities, two main missions per se. The first one, make sure we have full employment, make sure everyone there has the ability to actually get a job offer, which is actually kind of the case because we have 11 million opening jobs right now in the US economy. The second mission is to make sure inflation doesn't get out of control, because in case it does, well, it slows down the economic growth and we get into what we call a recession. All right. Now, he said a lot of things, but I'm going to just highlight on two main things he said about what can actually have a direct impact on AMC stock and the short squeeze. Well, first off, he said that there is highly uncertain that the Ukraine impact, is going to actually have a change into what they actually already thinking about increasing interest rates. But it said something else that actually speaks volume. First of all, he recognized that, well, we said maybe the 2% was kind of the target, but it's clear that the 2% target that the Fed initially had, inflation is already above that. So they recognize that they are kind of behind what they needed to be doing for the last maybe 6 months or so, when inflation was just kicking in. All right, meaning maybe they were kind of late into increasing interest rates. Now, he also said that he sees a series of quarter percentage point, meaning 0.25% increases coming, though he left open the possibility of moving more aggressively should inflation persist. This is where things will get very interesting for all of the AMC stockholders. Why? Because right now, because of what is happening in Russia, they have to be a little bit careful. That what is happening in Russia already have the potential of dragging the markets down. That's why markets have been so bipolar lately. We are still sitting way below what the market was sitting at the end of December, right? And this is because this war or this invasion from Russia, it's not something good for business, all right? So because of that, the Federal Reserve, Jerome Powell, had to be a little more careful about approaching interest rate increase. Now, by acknowledging that they have the open door, the possibility of moving more aggressively and increasing a lot more, it means, well, in March, it's clear that it's going to increase to 0.25%, which is already kind of priced into the market. But what is not priced in yet is the fact that, if inflation continues to be sticky, they're going to start, leveling up a lot more faster. Why? Because when you look at oil is already at 110 plus. Today it hit $112 a barrel. This has not been seen for the last 14 years. And I'm going to share with you in a separate video later today. You really need to watch that video. People are already thinking that oil can hit $150 a share. Why? Because Russia is pretty much the second largest producer of oil. So if nobody wants to actually do business with them, neither buying their oil they're producing, but on top of that, nobody is producing additional oil, well, it means oil is going to continue to increase. That is at least what I see for the foreseeable future, given the current market conditions on energy sector. Based on that, I bet you that inflation is going to continue to rise very, very high beyond the expectations, and it's going to make the life of, some of the consumers a lot more, painful at the price per se. But the bottom line for AMC is when they decide to ramp up, and they will, because according to what I just explained to you, inflation is not going to slow down, at least before this whole thing with Russia and Ukraine stops. So by increasing a lot more faster, they are going to make sure, it's going to have an impact on how huge interest rates on debt is going to be, all right? So if you have debt, and we already know so far, based on the calculation we made today, that, hey, if we have hundreds of millions or even billions of millions of billions of shares that are synthetics, they had to go in debt in order to get those synthetics from banks like Morgan Stanley, Goldman Sachs, which by the way, or Credit Suisse, which by the way are already being heavily investigated and have a lot of pressure into what the DOJ is investigating with the block trade probe. So can you kind of see what is coming for them? On one hand, they have market instability. All of the tech stocks, Snowflakes, Palantir, Neo, Lucid, are crashing because earnings are disappointing, which was kind of not a surprise. On top of that, you have the regulators, Department of Justice, and new policies that are about to flood, Wall Street, hence making it a lot more difficult for the short sellers to still maintain those short positions. And now that we have the Federal Reserve looking at how can we do to make sure inflation goes down, they're going to make sure that, hey, debt will cost you even more money that you are losing by having those short positions open. So if you kind of weigh everything in the balance, if you kind of weigh everything into, a scale, it doesn't look good because this adds to the additional pressure on short sellers, hence forcing them to actually do what we are all waiting them to do, which by the way, it's not a if, it's a when. All right. So all the signs are already there. It's just a matter of everything kind of lining up perfectly, and boom, when it starts, you will start noticing because your bank account will definitely bounce.